So let me just pull on a couple of the indicators that you have mentioned here. Let's start with a rapid rise in oil prices, and um, we've observed the same phenomenon, the same pattern, where a 50% year over year or greater than 50% year over year rise in oil prices, rise in gasoline prices has predated recessions and stock market corrections in the past. Some of the sell side analysts have been putting out decks that show that there's been such a decline in energy intensity over the last decade or two, especially in Western markets, where you just need fewer units of energy input. So, in other words, fewer barrels of oil or gasoline, it's fewer units of natural gas to produce the same amount of GDP growth, and therefore the rapid rise in gasoline and energy prices may not have the same recessionary causal impacts this time around. So maybe just let's knock down a few of the more common arguments against some of these more commonly recognized indicators of recessionary risk. So any thoughts on that, the decline in energy intensity and the fact that that may not trigger recession in this case?
I don't think I have the power to knock down those arguments. There is definitely decline in energy intensity, and there also, compared to decades ago, US has less energy. Like if you just become US centric, has less energy dependence. We're actually net energy producer, right? We could export energy. We don't have to import energy. All of those factors are so, and all of those factors to be adjusted. But I want to go back to my early point. Patterns have higher chances of repeating than otherwise. And what I'm thinking that it's not necessarily that the energy is dragging on global economy as a tax, it's just the kind of conditions that cause the rise of energy are typically concurrent with pre-recessionary conditions. It's like what's going on in the pipelines of the world which causes energy to spike is usually the type of things that go on before the growth rolls over. That's my kind of justifications. I'm not gonna, the mechanics of how whether oil price in itself is going to cause a recession in the United States, in some sense, I don't see that mechanics. I don't think by itself it's a recessionary thing. You could even argue it's inflationary because we have a lot of energy producers and their bonds will do better and whatever. But the sharp rise, it may be even that the sharp rise in energy, for example, leads to quick restructuring of energy demand in the energy industry, that it leads to subsequent sharp decline in energy, and we can talk about this. For example, I put in increasingly high probability and absolute crush in energy in the next couple of years, and we can talk about why. And that could be the recessionary situation, because there's a saying that the best cure for high oil prices is high oil prices. Yeah. Because people start producing more, rethinking the infrastructure. Other countries start increasing production, increasing domestic production, energy independence, and then 2-3 years later, you have prices way lower than the forward curve implies. Not brave enough to be short oil necessarily here, because the backwardation is already very strong, so you have to be very brave to short deferred oil. But the possibilities, how that plays out, are right.